Hi and welcome to Investing Basics, Risk Profiling and Asset Allocation. In the previous video, which was Investing Basics, Risk Profiling, we really very simply tried to identify one, your risk tolerance, secondly your return objectives, and then obviously a third thing flowing out of those two is let's call it your investment objectives or your investment philosophy. So if you didn't complete the previous video and do the risk profiling exercise, we suggest you pause the video here, just go back, do the risk profiler quickly, and then you can resume. Alright, so now that we've got your risk profile, the important thing is to try and allocate assets. So in other words, you want to try and match your assets to your risk profile. And we believe there are two steps in this. The first one is to choose an asset mix, so the ratio between the different asset classes, and then the second and slightly more complicated part is to tailor your assets within the asset class or asset classes rather. Okay, so in terms of the asset mix, every asset obviously offers you firstly a degree of initial income, secondly it offers you the prospect of some degree of income growth, and then thirdly it offers you on the possibility at least of some degree of capital growth, gain or capital loss. So if you take a money market instrument which is very suited to conservative investors, offers a high degree of certainty of what you're going to get in terms of interest, offers you no income growth though, and obviously offers you no capital growth either. A share or an equity, on the other hand, offers you a relatively unknown degree of income, dividend, but it does give you the promise, if the company performs over time, or the probability rather, of income growth to keep pace with inflation. And then allied to that, of course, is it gives you a reasonable probability of capital growth on the long term. So looking at the next slide, and I'm not going to dwell on this too much, but you can take 5 risk profiles there, and you can see the asset allocation per asset class. So taking cautious, for example, you can see equity is relatively down weighted because, as the name suggests, it's a fairly conservative strategy. One holds a fairly high degree of cash and bonds or fixed income assets, really just to try and produce a high level initial income. If one goes over, say, to moderate growth, you see the equity component skyrockets to 70%, virtually no bond exposure, and very limited cash. Okay, so I'm just going to very quickly illustrate in pie charts 3 different asset mixes on 3 different profiles. Firstly, we were just talking about the cautious profile. As you can see, cash and bonds representing just over 50%, so it gives you a relatively high degree of initial income, but it does give you some degree of inflation protection both in income and capital through the introduction of 30% in equity and 20% in 15% in property. A balanced profile obviously is slightly more aggressive. It's looking, as we suggested, at a healthy blend between current income, future income growth, and capital growth. Obviously, in order to achieve the income growth and the probability or possibility of capital appreciation, one needs to expose oneself to growth assets, and that's really equity and property. As you can see in a balanced profile, we have a 60% allocation to equity, only 10 in cash, 10 in bonds, and 20% in property. So really 80% of those assets are allocated to assets that will give you a reasonable probability of income and capital growth over time. But very importantly, the underlying components of the equity bucket are very important. And then just very quickly on a growth profile, the asset mix here, as you can see, a lot more aggressive. You right up to 80% in equity, virtually no cash, and a fair amount of property. As the name suggests, the real priority here is to achieve capital growth, so no point in holding a big block of cash or fixed income. Those assets are not going to achieve the capital growth over time. Right, then the second step in the process, now that we've identified the asset mix, is then to tailor the assets within the asset class. We believe quite firmly that a lot of investment houses overplay the role of asset allocation and tend to follow a one size fits all in the underlying asset bucket. We believe, though, that one must tailor the assets to the profile. So by definition, the equity component of a conservative investor would look fundamentally different to the equity component of an aggressive growth investor. And we feel very confident that it is this tailoring within the asset class that actually affords us the flexibility to hold slightly more weightings in equity and property than many of our peers. This next slide is very busy. I don't want to go through it too much, but really what we're just trying to illustrate, and we'll just take the equity component. Basically, we've got three bands there. You can see conservative, cautious and defensive. Those two conservative profiles share a high visibility, sort of dividend-oriented equity allocation. When you look at balanced and moderate growth, they follow a similar profile of looking for companies that offer a reasonable degree of dividend visibility and some real earnings growth and dividend growth over time. And then when one looks at growth and high growth, obviously the emphasis shifts away from visibility, predictability and dividend and moves towards growth. But as you can see, every asset class there, we believe there should be some degree of tailoring. So for example, high yield, visible dividend streams would be what we would be looking for the property component in conservative portfolios, but obviously we'd be looking for more growth and redevelopment and development opportunities in growth mandates. Okay, so hopefully this has made a little bit more sense. The real work starts now. Now you need to unfortunately go through the investing basics and maybe even go into the slightly more advanced investing, where one starts trying to understand how different assets within an asset class, so how different shares can give you very different risk return profiles. So we hope you've enjoyed this, and we encourage you to watch the subsequent videos and investing basics. And please remember, this is really just meant to be instructional or educational. It should never be seen as financial advice. Thank you.